When you look at today's charts, are you seeing a falling knife, a glaring sell signal? Or is this heavily discounted asset actually like a screaming strong buy that some people claim is massively undervalued?
I mean, it is the ultimate Rorschach test for traders right now. What you see on that chart says, it says a lot more about your inherent risk tolerance than anything fundamentally true about the asset itself.
Right. And before we jump into the numbers, do us a huge favor. Like this video, subscribe to our YouTube channel, and you absolutely must leave a comment with your feedback below. We really want to know where you stand on this.
Yeah, let us know, because the instrument we're analyzing today fundamentally breaks all the traditional rules of, buying low and holding.
Exactly. So our mission for this deep dive is to sift through the data, specifically looking at reports from investing.com, MarketWatch, Denelfin AI, and stockinvest.us, right around mid-April 2026.
Right.
We're trying to figure out what the GraniteShares 2X short TSLA Daily ETF, ticker symbol TSDD, is actually doing.
Yeah.
Because betting against Tesla often feels like, I don't know, trying to step in front of a moving freight train.
Oh, absolutely. And we have to establish right away that this isn't just a regular short position. It's an amplified daily bet. And understanding that is the key to unlocking this whole puzzle. TSDD seeks to provide negative 200% of the daily price performance of Tesla.
Okay, let's unpack this. Because amplified daily bet sounds, simple on the surface.
Yeah.
But the underlying machinery here is completely alien.
Very much so.
If I want to see if a regular company is undervalued, I open up the hood, check the income statement, quarterly and annual, look at the cash flow, right? But the balance sheet for this ETF is just bizarre.
Yeah, if you approach this with a traditional value investing mindset, your head will absolutely spin. I mean, the CPF doesn't manufacture cars, it doesn't write software, it fundamentally has zero cash flow from actual operations.
Wait, so what exactly is sitting on the balance sheet? If you hit the buy button on TSDD, what do you tangibly own?
You basically own cash equivalents and derivative contracts. Because it's an inverse leverage ETF, the fund enters into these massive swap agreements with institutional heavyweights.
Oh, like who? Are we talking big banks?
Yeah, exactly. Major financial institutions like Bank of America, Merrill Lynch, or Clear Street. The ETF uses these over-the-counter swaps to guarantee that exact negative 2x daily exposure.
Wait, hold on. So when you buy this, you aren't buying a piece of a business that makes things good. You're basically buying a highly engineered daily contract with a bank.
That is exactly what you're doing. You are entering a contract that dies and is reborn every single day at the closing bell.
Man, that completely changes the definition of investing. So let's look at the financial footprint of this thing, based on the April 14, 2026 close. The price is sitting at $10.72, but the extreme volatility here is insane. The 52-week high was $58, and the low was $6.87. We're talking about an asset that lost nearly 90% of its value from peak to trough and then just rallied.
Yeah, that swing from 58 down to under 7 is just the heartbeat of institutional leverage. But, managing that wild oscillation, it comes with significant overhead.
Which brings us to the costs. Who is buying and selling this to keep it afloat? The assets under management, the AUM, is fluctuating heavily between $44.07 million and $62.4 million.
Mm-hmm.
And the expense ratio is high, like 0.95% net and about 1.13% gross.
Well, yeah, because that 0.95% isn't paying for, like, a CEO's private jet or an R&D facility.
Right.
It's paying for the massive daily liquidity they need to keep those swap agreements alive with the banks. Every single day, the fund managers have to rebalance their exposure. You're paying a premium for relentless financial engineering.
Sure. But here is the most ironic quirk I found in the MarketWatch data. This 2x short ETF, this ultra-aggressive bet against the most futuristic tech company on Earth, it boasts a dividend yield of around 6.07% to 6.24%.
Well, wild, isn't it?
The last payout was 65 cents back in December 2025. How on earth is a daily derivative contract paying out a 6% yield?
This is honestly one of the most fascinating paradoxes in modern finance right now. Remember when I said the fund holds cash equivalents as collateral for the bank swaps?
Right.
Well, in a macroeconomic environment where global interest rates are elevated, that massive pile of collateral isn't just sitting there doing nothing. It's invested in short-term treasury bills and money market funds.
Oh, wow. That is brilliant. It's just deeply ironic.
Yeah.
So you think you're executing this aggressive, high-risk short on Elon Musk, But structurally, you've just become a passive collector of boring government treasury yields.
Yeah. Precisely. The banks require safe collateral. Safe collateral yields interest. And that interest gets passed along to the ETF shareholders as a dividend. It's basically an accidental perk.
That's crazy. Okay, but because this ETF resets every single day, traditional long-term valuation metrics are basically useless,
Yeah.
which forces traders to rely entirely on technical momentum and daily trading signals.
And the latest news on those signals is, well, it's a war zone. We are looking at a deeply fractured technical environment.
Yeah, let's lay out the battlefield.
Yeah.
As of mid-April, the short-term trend is in a pronounced downtrend. It dropped for 4 consecutive days leading up to April 14th.
Right.
But if you zoom out just a fraction, the medium-term trend is mixed to bullish. It had a massive year-to-date return, surging somewhere between 41.6% and 48.5% from its recent absolute lows.
This is exactly where algorithmic trading desks start to short circuit, because the moving averages are violently contradicting each other. It's absurd. Key support is currently sitting at the long-term average of around $10.09, while resistance is capping the price at the short-term average of $11.61. But look at the divergence. The 10-day simple moving average is at $11.30, flashing a glaring sell. Meanwhile, the 200-day simple moving average is sitting above the current price at $12.47, flashing a buy.
And if you look at momentum oscillators, it gets even messier. The 3-month MACD recently showed a buy signal based on the broader recovery trend. But then the short-term pivot signals abruptly flipped negative on April 8th.
It's like a broken GPS. Turn left, no, turn right. How on earth is a retail trader supposed to read a map when the short-term says sell and the long-term says buy?
Well, they often don't, which is why we see such a huge tug of war in the analyst ratings you pulled. When the data is this conflicted, the analytical models have to choose what to prioritize. Yeah, Danilfin AI rates it a 4 out of 10. Firm hold. They're looking at the negative signals and the conflicted short-term outlook, basically saying, stay on the sidelines.
But then you have stockinvest.us.
Right. Stockinvest.us is coming in hot. They see a short-term buying opportunity, wildly forecasting a potential rise to between $14 and $17 in the next 3 months, despite the high volatility.
And see, this is where we have to transition into the most dangerous part of this whole deep dive, the whole undervalued versus value trap debate.
Because following the wrong signal here is brutal.
Right, exactly. If you buy this thinking, oh, it's just an undervalued stock primed to return to its $58 high, you are walking blindfolded into a notoriously deadly trap that constantly burns retail traders.
Okay, let's dig into the risks. Earlier, we talked about how buying an asset at a severe discount from its 52-week high is usually like standard value investing. Why does that logic feel so hard with TSDD?
Because the primary downside risk isn't just that Tesla announces a breakthrough and the stock surges. The insidious risk is leverage decay, also known as compounding risk. This fund is explicitly designed for short-term tactical trading, not long-term investing.
So how does a retail trader actually get trapped? Like, what if Tesla's stock fundamentally goes nowhere over a month?
Well, what's fascinating here is the daily reset mechanism. Let's walk through the math step by step using really simple round numbers.
Oh, you lay it on me.
Imagine Tesla stock is trading at exactly $100 a share. You buy our negative 2x ETF, which is also conveniently priced at $100. On day one, Tesla has a terrible day. It drops 10%, falling from 100 down to 90.
Okay, perfect for us. We have a negative 2x multiplier, so our ETF goes up 20%. My $100 investment is now worth $120. I'm crushing it.
You are, until the closing bell rings. At that moment, the fund rebalances to maintain its institutional swaps. So your new starting line for tomorrow is $120. Now, on day two, Tesla's stock recovers perfectly. To get from $90 back to its original 100, the stock needs to rise by roughly 11.1%.
Yeah, 11.1% of 90 gets you back to 100. So Tesla is completely flat over the 2 days.
Exactly. Tesla goes up 11.1%. But you hold a negative 2x ETF. Your fund must now go down by 22.2% from its new starting point.
Oh, man.
So we take a 22.2% loss on your $120. That is a drop of about $26.60. Your ETF falls to roughly $93.40.
Wait, that is staggering. Tesla went from 100 down to 90 and right back to 100. The underlying asset didn't move an inch over 48 hours. But my ETF went from 100 up to 120 and then crashed to 93.40.
Yes.
I lost almost 7% of my capital just to the mathematical friction of the daily reset.
That is leverage decay. Every time the underlying asset gets incredibly choppy or goes sideways, the daily compounding mathematically erodes the value of the ETF, even if Tesla hasn't technically gone up against you.
So buying this because the $10 price tag looks cheap compared to the $58 high is a classic trap. You aren't buying a discounted company. Plus, the concentration risk, you are entirely at the mercy of one single, highly volatile stock.
Exactly.
So if the mechanics are this dangerous, why does this asset even exist? There must be a specific optimal scenario where this actually works. What is the ultimate bull and bear case here?
The best case recovery scenario is that it works perfectly as a highly tactical surgical hedge against Tesla's high volatility, or maybe a sudden valuation correction in the broader EV sector.
So like a day trading tool.
Right. And your sources show that it has actually demonstrated strong, recent, risk-adjusted returns, what we call alpha 6M, when rebounding from historic lows. It captures violent downward momentum flawlessly if you time it right.
Got it. And the bear case, the worst case continuation lower.
The bear case is that bearish pressure persists after a recent pivot top. If it fails to find a new bottom pivot and volume continues increasing on falling prices, the descent just continues. Plus, that sideways compounding decay will slowly bleed the remaining AUM dry.
And as we're looking at this mid-April 2026 data, the performance here is heavily dependent on some major catalysts, like Tesla's upcoming quarterly earnings report.
Oh, that is the spark. If the earnings report shocks the market, we get the volatility this instrument needs. But there is also the macro side-shifting global interest rate expectations.
Because EV companies are so capital intensive.
Exactly. Higher interest rates suppress the valuation of growth stocks. So algorithmic desks reprice Tesla instantly, the stock drops, and our inverse ETF spikes.
So what does this all mean? The immediate short-term outlook is bearish pressure, but the long-term perspective is just do not hold this long-term. You aren't just betting against Elon Musk for a day. You're making a high-speed macro bet on EV sentiment and global interest rates.
That is exactly right.
So we're left with this massive uncertainty hovering over the market. Will the impending Tesla earnings report vindicate the short sellers and trigger a massive spike toward that $17 forecast? Or will it crush them once again, leaving retail traders caught in the value trap?
It really is the ultimate high-stakes drama.
It is. And we had to state this explicitly for you, the listener. Everything we've unpacked today involves natural human debate and analysis of the data, but it's absolutely not financial advice.
No, especially when dealing with amplified derivatives, you really have to do your own research.
Exactly. We started by asking if this was a falling knife or an undervalued diamond. But based on the sources, I want to leave you with a different, much more provocative thought to mull over on your own.
I love this one.
If a financial asset is mathematically designed to decay and destroy its own value over time through daily rebalancing, is it actually an investment at all? Or is it just a casino chip with an invisible expiration date? Think about how that changes your definition of what it means to buy a stock.
That really forces you to question what you're looking at on those charts.
It absolutely does. Thanks for joining us on this deep dive. Catch you on the next one.